Welcome to the Practical World Podcast, your gateway to work insights and captivating stories from Thailand and beyond. This is the real world. This is the Practical World Podcast.
Welcome to the deep dive. Let's get straight to it. Gold in 2025.
Right.
You're likely looking for the essential knowledge quickly and thoroughly, especially, with gold prices surging past $3,200 an ounce amidst all this market volatility.
It's been quite a ride.
So we're diving deep into whether gold right now is, a genuine opportunity for you, or maybe primarily a shield against the economic storm.
Yeah, what's the real story here?
We've looked at a range of investment takes from detailed analyses to the latest financial news and different investment strategies, basically to bring you the core insights.
Exactly. Our aim is really to cut through the noise and understand gold's sort of dual role. Its classic status as a safe haven and its potential as an investment in today's, let's face it, uncertain climate. That uncertainty, the economic outlook shifting, geopolitical tensions bubbling up, and markets feeling jittery, it really puts gold in a key position, doesn't it?
It does. It really makes you wonder, with everything going on, is putting some capital into gold a smart move for you right now?
Good question.
Let's start with that safe haven reputation. What's making gold look so appealing as a source of stability lately?
Well, one of the biggest shifts we've seen recently is this dramatic jump in demand from central banks.
Right.
Projections for 2025 suggest they could be buying around 80 tons every month.
Wow, 80 tons.
Yeah. Now, just for context, before 2022, the average was more like 17 tons.
Big difference.
Huge. This near five-fold increase isn't just, routine tweaking of reserves. It really signals a fundamental change in how major economies are viewing global financial stability.
That scale of buying, it's pretty remarkable. So it's not just us regular investors seeking safety.
Not at all.
But isn't there a risk that if things, calm down globally, the central banks might flip and become sellers, potentially pushing prices down for you?
That's a valid point to think about. Absolutely. However, the current motivations seem, pretty deeply rooted in diversifying away from relying too much on single currencies and hedging against these geopolitical risks. Those factors might not just evaporate easily, even if immediate tensions ease a bit. And beyond the central banks, you've got the whole geopolitical landscape, the war in Ukraine, U.S.-China frictions, conflicts in the Middle East. It all adds to a heightened sense of global risk. And when you add in the significant talk about potential economic recession, maybe a 45% chance in the U.S. in the next year, investors understandably look for assets seen as stable, like gold ETFs, to sort of ride out potential storms.
Right, the classic flight to quality.
Exactly. It's what you often see in uncertain times.
Seeking solid ground when things feel shaky.
Precisely. And we shouldn't forget the cultural side either. In many parts of the world, like India, gold has this incredibly deep-rooted cultural value. It represents wealth, security passed down through generations. And that creates a consistent sort of underlying demand that helps support the market.
Okay, so a mix of big players and long-standing cultural factors boosting gold's safe haven appeal. But the investment world is always changing, isn't it? What new things are competing for that safe label? Maybe chipping away at gold's dominance for you.
That's a crucial point. Bitcoin and other cryptocurrencies have definitely emerged as, competitors in this space.
Right, the digital gold idea.
Kind of. Institutional investors often set aside maybe 10% of their portfolios for inflation hedges. And now, Bitcoin is actively vying with gold for a piece of that pie.
Interesting.
This really became noticeable around late 2020 when Bitcoin started getting more acceptance from institutional players. Its emergence as a, let's say, credible alternative for that slice of the portfolio forces investors like you to really reevaluate gold's unique value proposition.
Got it. So gold isn't the only port in a storm anymore. Okay, having looked at gold as a safety net, let's switch gears to its potential for growth. And as we'll see, the experts seem to have very different views on that for you. What's the short-term picture looking like?
In the short term, the outlook seems, quite bullish for some. Goldman Sachs, for instance, recently bumped up their year-end price target for gold to $3,700 per troy ounce.
$3,700.
Wow. Yeah, up from $3,300. They're pointing to that continued strong central bank buying and rising recession risks as key drivers.
Okay.
They even said the risks to their forecast are skewed to the upside, meaning they think prices could go even higher in the near term for you.
$3,700. That's a number that would definitely make you pay attention in your planning. What else is feeding this short-term optimism besides Goldman?
Well, there's also a sense of optimism among many retail investors, too. You see some projections floating around for $2,700 to maybe $3,000 by the end of this year.
Mm-hmm.
Technical analysis, for those who follow charts, currently seems to suggest upward momentum for gold.
Okay.
And we've also seen how quickly gold can rally on global news. Like, remember that jump of over 2% in a single day during a U.S.-China trade flare-up? Pushed it over $3,100.
Right, very reactive sometimes.
Yeah.
Exactly. Plus, the expectation that the U.S. Federal Reserve might ease up and cut interest rates is generally seen as a positive for gold prices in the short term for you. But yeah, short-term traders always face that volatility and the tricky business of timing the market just right.
Okay, so quite a few things pointing towards a potentially bright short-term outlook. But what about the longer view? What headwinds should investors be aware of for their longer-term strategies?
Looking further out, you definitely see a more cautious perspective. Take analysts like John Mills at Morningstar.
Okay.
His forecast actually projects a significant decline in gold prices, potentially down to $8,820 an ounce over the next 5 years.
$1,820. That's a huge drop.
It's a substantial 38% drop from recent highs, yeah. His main reasoning is the expectation of increased gold supply.
Ah, right.
Sustained high prices tend to encourage mining companies to, well, mine more.
That makes logical sense. Higher prices mean more profit, which fuels more digging. Is there data backing that up that you should know about? Yes, actually. Data from the World Gold Council showed that gold mining got pretty profitable recently. Average profit margins hit around $950 an ounce in Q2 2024.
Wow, $950 an ounce margin.
Yeah, that kind of profitability definitely creates a strong incentive for miners to boost output, which could indeed lead to more supply coming online in the next few years.
So, potential for more gold hitting the market down the road. Are there other long-term things that might dampen gold's appeal for you?
Well, from a technical analysis angle, some chart watchers see a long-term cup and handle pattern that could suggest a potential price target around $2,900.
Okay, cup and handle, usually bullish. Right.
Generally seen as a bullish continuation pattern, yeah. Suggests a possible breakout after consolidation. However, other analysts focus on fundamentals, like the relatively low inflation we've had since the 2008 crisis, despite all the money printing.
Right.
This low inflation backdrop might limit how high gold can realistically go in the long run for you. It's also worth remembering, historically, like from 1971 to 2019, gold's nominal returns before inflation averaged about 10.6% a year. After inflation, the real return was much more modest, maybe 1-2% per year.
Just keeping pace, basically.
Pretty much. And historically, gold has tended to lag during periods of strong economic growth and low uncertainty, like the 1990s. It actually lost value then for investors.
Okay, so a real split depending on your time frame. Now, for someone thinking about actually adding gold to their portfolio, there are several ways to go about it, aren't there?
Absolutely. You've got several main options, each with its own, pluses and minuses for you. The most traditional is, of course, physical gold.
The actual bars and coins. What are the pros and cons if you choose to go that route?
Well, on the plus side, you get tangible security. You physically own the asset.
Hmm.
For many, that gives a sense of comfort, especially if they're worried about the financial system. It's direct ownership. And in extreme situations, maybe it could be used as exchange. Plus, there's the cultural appeal we talked about.
Sure.
But the downsides are significant for you. You've got storage and security to think about, vaults, safes, insurance that all costs money.
Right.
You'll usually pay a premium over the spot price, the market price, when you buy physical gold. And that premium can be higher for smaller bars or coins.
Okay.
Then when you sell, there are transaction costs. And depending where you live, profits might be taxed at higher collectibles rates.
So while holding a gold bar might feel good, the practical side needs real thought. What about the more modern way, gold ETFs?
Gold ETFs like GLD or IAU, they offer a much more accessible path for many people. You skip the whole storage and security headache.
Hmm.
These ETFs trade on stock exchanges like regular stocks, so they're very liquid, easy to buy and sell. Generally, the costs are lower than storing it yourself, although you do pay management fees to the fund.
Okay.
And we've seen a link recently between rising gold prices and money flowing into these gold-backed ETFs. They can be a good option if you want exposure to the price without the physical hassle, maybe for shorter term moves or tactical plays for you.
But you don't actually own the gold.
Correct. You don't directly own the metal itself, you own shares in the fund that owns the gold. And again, some ETFs might get taxed as collectibles.
Okay, ETFs sound more convenient for many. What about investing in the companies that actually dig the gold out of the ground? Mining stocks.
Right, gold mining stocks. They give you a different kind of exposure. When gold prices go up, these companies' profits can rise even faster, offering potentially leveraged returns for you.
Leveraged. Okay.
They might also pay dividends, and they're usually pretty liquid, easy to trade. And as we mentioned, their profit margins have been quite healthy lately.
But there must be catches.
Oh, definitely.
Yeah.
It's crucial to understand they come with extra risks beyond just the gold price. Things like problems at the mines, political issues in mining countries, how good the company management is, even how the overall stock market is doing all that can affect their performance.
Right, lots more variables.
Exactly. They might not hold their value as well as physical gold in a big market crash. So there may be best seen as a complement to owning bullion, not really a substitute for stability. And they definitely require more homework for you.
Mm-hmm. Amplifies gains and losses, you mean?
Precisely. It's a higher beta play on gold, not a direct safe haven itself.
Makes sense. And then there's this digital gold idea some of you might be hearing about. What's that about?
Digital gold basically refers to online platforms where you can buy and hold fractional amounts of gold electronically.
Okay.
It's super convenient, buy, sell instantly, often with really low minimum investment amounts. The platform handles the storage, usually securely.
Hmm.
It gives you flexibility for making regular small investments, generally high liquidity, easy to convert back to cash, and sometimes you can even redeem it for physical gold. Plus, there's usually good transparency on pricing and what you hold.
Sounds easy. What's the risk?
The main one for you is counterparty risk. You're trusting the platform to actually hold the gold they say they do and to stay reputable. You also don't have direct physical access unless you go through redemption, which might have fees. So choosing a trustworthy platform is really essential for you.
Okay, lots of different ways to get gold exposure, each with trade-offs you need to weigh up. Now, stepping back, how does gold typically fit into an overall investment strategy? What jobs does it usually do in a portfolio for you?
One of the most common roles cited is as a hedge against inflation. Historically, gold has tended to hold its purchasing power over long stretches,
Hmm.
but in recent decades, especially after 2008 when inflation was pretty low, that relationship hasn't been quite as consistent.
Okay.
In the current environment with higher inflation, gold has responded positively. But like we said, it's got competition now from things like Bitcoin for that inflation hedge slot in your portfolio.
Right.
Looking back at data, gold performed best during high inflation, like over 5%, delivering pretty significant average annual returns, both nominal and real.
And moderate inflation.
In moderate inflation, say 2-5%, it tends to grow more moderately, kind of keeping ahead of prices. But in low inflation, below 2%, the returns have been quite minimal for you, barely keeping pace.
So, not a perfect inflation shield in every situation. What about its role in diversification for your portfolio?
This is arguably where gold shines most consistently in modern portfolios. It tends to have a low correlation with stocks and bonds.
Meaning its price doesn't move in lockstep with them?
Exactly. Its price movements don't always mirror those other major asset classes. This is especially valuable during market stress when stocks and bonds might be falling. Gold can act as a buffer, potentially reducing the overall ups and downs of your portfolio.
Hmm.
That negative correlation during downturns is a key attraction. It can also provide liquidity cash during crises when other markets might seize up.
Okay.
Historical data, say from 2002 to 2022, suggests gold's volatility has often been lower than stocks and many other commodities. Studies have even suggested that a relatively small allocation, maybe 5 to 10% to gold, can actually improve the risk-adjusted returns of a portfolio for you.
Risk-adjusted returns. So, better returns for the amount of risk taken.
Precisely. It's often seen as a kind of insurance against market crashes or monetary crises. It's even a component in some long-term stability strategies like the permanent portfolio.
Okay, so more about stability and acting as a counterweight. What about the potential for gold to actually go up significantly in value for you, capital appreciation?
Well, it certainly has shown it can do that, as we've seen with the roughly 23% gain in 2025 so far.
Right.
But as that big difference in price forecasts from Goldman and Morningstar highlights, There's considerable uncertainty about its future price moves.
Mhm.
Its performance will really depend on how all those factors we've discussed, central banks, geopolitics, supply, demand, market mood, how they all play out for you.
This has been incredibly insightful. Now, for someone just starting to think about investing in gold, what would be your key beginner's advice for them?
I think the most important first step for you is getting your basic financial house in order,
Nino.
meaning having a solid emergency fund, ideally 6 to 12 months of living expenses saved up.
Okay, foundation first.
Exactly.
Mm.
Also, it's generally wise to view gold as a longer term holding, maybe you think 20 years or more, to potentially capture those diversification and hedging benefits.
Mm.
And be aware that trying to time the market or selling gold too early, especially chasing short term gains, often leads to losses because of transaction costs and price swings for you.
Solid advice.
Mhm.
What about starting specifically with physical gold? Any tips for someone considering that?
If you're leaning towards physical gold, definitely do your homework first. Visit reputable coin and bullion dealers. Get familiar with the different products.
Okay.
Maybe consider starting with denominations of at least 110th of an ounce. This helps manage the premium you pay over the spot price, as those premiums tend to be proportionally higher on the really tiny pieces. Think about a strategy of systematic accumulation, like dollar cost averaging, investing a fixed amount regularly over time.
Mm-hmm.
And crucially, have a secure storage plan figured out before you buy, whether that's a good home safe, a bank safety deposit box, or maybe professional vault services, depending on how much you have.
And for those who maybe aren't ready for physical gold just yet, any alternative starting points for them?
Yeah, definitely alternatives for beginners. Some companies offer gold savings programs where you can make small, regular investments in allocated gold that they store for you.
Okay.
Depending on where you live, there might be tax advantaged options like sovereign gold bonds.
Mm-hmm.
And for people who just want liquidity and ease of access through their regular brokerage account, gold ETFs are a pretty straightforward way to get exposure to gold prices without the logistical hassles of the physical stuff.
We've touched on how gold behaves in different scenarios.
Mhm.
How has it actually done during major crises and high inflation periods for you?
History really does highlight gold's role as a crisis hedge. If you look at major crises between, say, 2007 and 2023, that includes the 2008 financial meltdown, the COVID pandemic, the start of the war in Ukraine,
Right.
gold on average gained about 12% during those periods, while the S&P 500 on average fell around 14%.
Big difference.
Yeah, it really tends to perform well when other assets are under pressure. Conversely, in more stable, peaceful economic times, gold's performance could be pretty lackluster.
Mm-hmm.
But when conditions worsen and uncertainty spikes, gold often sees significant upward moves.
So it tends to be cyclical, reacting to the level of global worry you might be seeing. What about specifically during high inflation times?
When inflation has been high over that 5% mark,
Yeah.
gold has historically shown strong performance, often significantly beating the rising cost of living. In more moderate inflation, it tends to keep pace. But yeah, in low inflation periods, returns have been minimal. The recent high inflation period, starting around 2021, definitely saw gold prices rise substantially, kind of reinforcing its role as a hedge against inflation and negative real interest rates, leading to those record highs we've been talking about.
So, pulling it all together, then, what's the main takeaway about gold's role in today's uncertain world for you?
I think in this current climate, which is definitely marked by global uncertainty, gold really stands out mostly for its defensive qualities
Hmm.
and its ability to diversify a portfolio.
Okay.
The ongoing geopolitical tensions, plus the nagging risks of inflation and market volatility, they create a pretty compelling case for considering some allocation to gold within your overall investment strategy.
Hmm.
We are seeing these short-term price increases driven by that safe haven demand right now. And yeah, if global instability hangs around, there's potential for more gains. But it's really vital to remember the inherent volatility in gold prices.
Right. It's not always a smooth ride up. It's exactly.
Mm,
Gold's long term value proposition really revolves around its ability to preserve wealth and act as a hedge against inflation and potential currency devaluation. It also offers that crucial portfolio insurance during major economic and market crises. But remember, it's not perfect, and it can definitely see price corrections.
sure.
It's generally best used as a component, maybe a single digit or low teens percentage of a broader, well diversified investment portfolio. That's where you really get the diversification and hedging benefits.
Okay.
And the choice of how to invest physical ETFs, miners, digital, that really needs to be based on your individual needs, your risk tolerance, and what you're trying to achieve with your investments.
So, a balanced, considered approach is key for you. Well, this has been a truly thorough deep dive into gold in 2025.
Sure.
Thanks so much for sharing your expertise.
My pleasure. Glad to discuss it. And for you, our listener, as you think about everything we've covered, how might a modest allocation to gold realistically fit into your overall financial strategy? Maybe take some time to consider your own comfort with risk, your long term security needs, and how gold's potential to buffer against turbulence and preserve wealth might play a role in your financial future. It's definitely something worth mulling over as you navigate your own investment journey.
Thank you for joining. This is the Practical World Podcast.